On March 1st, 2026, the banks quietly tightened the entire financial system, and almost nobody is talking about it in a way that actually explains what changed and what it means for you personally. There were no viral headlines, no breaking news countdowns, no dramatic press conferences with regulators standing at podiums explaining what they just did. It just happened. Behind the scenes, in the language of regulatory filings and compliance bulletins that most people never read, the system got measurably tighter overnight. ACH fraud monitoring got stricter. Real estate reporting expanded significantly. FDIC digital disclosure requirements changed. The CFPB updated PACE regulations, capital supervision across financial institutions was tightened, and credit union interest rate caps were extended all in the same month. That is not a coincidence. That is not a series of unrelated administrative updates happening to land at the same time. That is a coordinated system adjustment, and if you use a bank account, Zelle, direct deposit, cash deposits, real estate LLCs, or credit unions, you are operating inside a tighter financial system today than you were in February. So let's break down exactly what changed, why it matters, and most importantly, what you can do about it. There are 6 distinct parts to what happened this month, and I do not want you to skip a single one of them because each one carries real impact for real people, depending on how you manage your money. Let's start with the one that is going to affect the most people in the most immediate and personal way, which is the ACH fraud monitoring changes. The updated rules from NACHA, which is the organization that governs the ACH network, went into effect with implementation beginning March 20th, 2026. If you have never heard of NACHA before, here is why you need to understand who they are. The ACH network is the backbone of electronic payments in the United States. When your paycheck hits your bank account through direct deposit, that is ACH. When you pay your electric bill online, that is ACH. When you send money through Zelle, when you receive government benefits, when you transfer money between your own bank accounts at different institutions, all of that runs on the ACH network. NACHA sets the rules for how that entire system operates. So when NACHA updates its rules, it is not a small or isolated change. It touches virtually every financial transaction most Americans make on a regular basis. The 2026 NACHA updates require what they are calling enhanced risk-based fraud monitoring across all participating financial institutions. In plain language, what that means is that banks are being required to turn up the sensitivity on their automated fraud detection systems. And I want you to really sit with what that means because the implications are significant. These systems work by building a behavioral profile of you as a customer based on your historical transaction patterns. They learn what is normal for you, how much you typically spend per transaction, how often you receive deposits, how frequently you move money, and in what amounts. They establish your baseline, and then they monitor everything you do against that baseline in real time. When your behavior deviates from that established pattern, the system flags it, not because anyone looked at your account and decided something seemed wrong. The algorithm detected a deviation, and the system responds automatically. Here are some examples of what that looks like in practice. If your typical transaction size is around $100 and you suddenly make a $900 purchase, that is a flag. If you normally receive 2 deposits per month and this month you receive 5, that is a flag. If you move money faster than your historical patterns show you typically do, that is a flag. None of those behaviors are inherently suspicious. They are all things that normal people do for completely legitimate reasons all the time. But the system does not evaluate intentions. The system evaluates deviation from pattern. And here is the part that I think is most important to understand clearly. When the system flags something, it does not pause and wait for a human to review it before taking action. The system freezes first and asks questions later. Your card gets declined, your transfer gets held, your account gets placed under review. All of that happens before anyone at the bank has actually looked at what triggered the flag. You find out not through an advance warning, but through something not working when you need it to work. And with these new NACHA requirements raising the sensitivity of those detection systems, the threshold for what triggers a flag has been lowered. That means more flags, more holds, more temporary restrictions on accounts belonging to people who have done absolutely nothing wrong. Now let's move into the second major change, which is the broader capital and supervision tightening that also took effect in March 2026. Regulators have placed financial institutions under heavier scrutiny across multiple dimensions simultaneously, including fraud mitigation protocols, liquidity stress testing, risk modeling requirements, and compliance reporting standards. When regulatory pressure on banks increases, the response from banks is predictable and consistent. They reduce their own risk tolerance. They tighten their internal monitoring. They conduct account reviews more frequently and more aggressively. And as a direct consequence of all of that, the rate of false positives increases. More regular customers get caught in monitoring processes that were designed to catch bad actors. This is not your bank deciding to make your life harder. This is your bank responding to the pressure it is receiving from above by making its own systems more conservative and more reactive. The pressure flows downward through the system, and it lands on you as the end user. Understanding that dynamic does not make the friction less annoying when you experience it, but it does help you understand why it is happening and how to navigate it more effectively. The third major change that took effect March 1st, 2026 is one that is going to matter enormously if you are involved in real estate investing in any capacity, particularly if you use entity structures like LLCs or trusts for your transactions. The Financial Crimes Enforcement Network, which is the Treasury Department division responsible for safeguarding the financial system from illegal activity, implemented what is called the Residential Real Estate Reporting Rule. This rule significantly expands reporting requirements for real estate transactions conducted through non-financed structures, including LLCs, trusts, and certain other entity arrangements. The stated goal is anti-money laundering enforcement, and the practical effect is substantially increased transparency requirements around who is actually behind these transactions. Beneficial ownership, meaning who ultimately owns and controls the entity making the purchase, is now subject to expanded reporting and documentation requirements. If you are a real estate investor who uses LLCs or trust structures, your compliance burden increased meaningfully as of this month. The documentation requirements are heavier, the reporting obligations are more extensive, and the visibility that regulators have into your transactions has expanded. This is not designed to stop legitimate real estate investing, but it does mean that operating within those entity structures now requires more administrative diligence than it did before March 1st. The fourth change involves the FDIC, and it deals specifically with how financial products are represented and marketed in digital environments. Effective March 1st, 2026, the Federal Deposit Insurance Corporation updated its digital advertising and signage requirements to mandate that banks clearly and prominently disclose their FDIC insurance status across all digital platforms where they operate. The reason this became necessary is that the explosion of fintech apps and digital banking products over the last several years created genuine consumer confusion about what was and was not insured. Apps that look and function exactly like banks are not always banks. Traditional banks frequently partner with fintech companies to offer products through those apps. Consumers using those products often had no clear way to know whether their deposits were actually protected by FDIC insurance. Regulators decided that needed to change, and the new requirements are designed to make that information impossible to miss, regardless of where or how you are interacting with a financial product. This is one of the changes that is genuinely straightforward consumer protection. The concern it raises is not about the rule itself, but about what it signals, which is that regulators are now actively monitoring how financial products are presented in digital spaces in ways they were not before. The fifth change involves the Consumer Financial Protection Bureau, and specifically an update to Truth in lending exemptions around PACE financing. PACE stands for Property Assessed Clean Energy, which is a financing mechanism that allows property owners to fund energy efficiency and clean energy improvements through a loan that is repaid as part of their property tax bill. The CFPB updated its regulations in this area to require expanded disclosures, stronger consumer protections, and greater clarity around the terms and obligations of PACE loans. The pattern here is the same pattern you see across all 6 of these changes. More disclosure requirements, more federal oversight, more compliance obligations, more documentation. If you are seeing a theme develop, that is because there is one. March 2026 represented a systematic and coordinated tightening across multiple dimensions of the financial system simultaneously. Each individual change might seem manageable on its own. Together, they represent a meaningful shift in the regulatory environment that everyone operating inside the financial system needs to understand. The 6th change is one that I think is going to hit a lot of people in an unexpected way, and it involves credit unions specifically. The National Credit Union Administration extended the federal credit union loan interest rate cap at 18% through September 10th of 2027. Now, here is why this matters and why the framing of it as a benefit requires a closer look. This cap was originally set to expire on March 10th, 2026. If it had been allowed to expire without extension, the cap would have dropped down to 15%. So the extension kept rates from dropping. And for borrowers, that means credit union loan rates can still go up to 18% on standard loans when they could theoretically have been capped at 15%. Additionally, payday alternative loans at credit unions remain capped at 28%. That is a rate that a lot of people would find genuinely alarming if they saw it on a loan offer. The NCUA's rationale for maintaining the higher cap is that dropping to 15% would have caused some higher-risk borrowers to lose access to credit at credit unions entirely, because credit unions would not be able to price the risk appropriately at a lower cap and would simply stop offering certain products. So the argument is that 18% access is better than 15% and no access. That logic has some merit, but it also means that if you are borrowing from a credit union right now, comparing rates carefully and understanding exactly what cap applies to your specific product is more important than ever. Now let me zoom out and give you the bigger picture, because I think the most valuable thing you can take from all of this is not any single one of these 6 changes in isolation, but what they tell you collectively about the direction the financial system is moving. Every single one of these changes points in the same direction. More visibility into your financial behavior, more monitoring of your transaction patterns, more documentation requirements for how you hold and move assets, more automation in risk detection and response, more compliance obligations across every type of financial activity, from basic banking to real estate to energy financing to credit products. This is a tightening cycle, and the effect of a tightening cycle is that the margin for unusual, inconsistent, or pattern-deviating financial behavior gets smaller. If your financial life is clean, organized, predictable, and well-documented, you are going to feel minimal friction from these changes. The automated systems are going to process your transactions without incident because your behavior fits neatly within established patterns. But if your financial behavior is variable, if you operate business activities through personal accounts, if you receive frequent Zelle payments in inconsistent amounts, if you invest in real estate through entity structures, if you move money internationally on any regular basis, your compliance burden increased this month. Not catastrophically, not in a way that should stop you from doing legitimate things, but measurably and in ways that you need to be aware of and prepared for. Let me give you a practical action plan, because awareness without action is just stress. The first thing I would strongly recommend is separating your business and personal banking if you have not already done so. Running business-related deposits and payments through a personal account is exactly the kind of behavioral pattern that the newly tightened fraud detection systems are trained to flag. It creates the appearance of unusual activity even when everything is completely legitimate. Keeping those two lives separate protects you from unnecessary friction. Second, start keeping documentation for any large or unusual deposits. If you sold something, if you received a large payment for a service, if you got a gift or an inheritance, have a paper trail that explains it. You may never need it, but if your account gets flagged and reviewed, being able to quickly provide clear documentation of where a deposit came from moves you through that process dramatically faster than not having it. Third, if you know you're about to make a large transfer that falls outside your normal patterns, consider notifying your bank in advance. A quick phone call or message through your banking app saying you are planning to transfer a specific amount on a specific date gives the institution context that can prevent the automated system from treating it as suspicious. Fourth, if you are involved in real estate using entity structures, make sure your beneficial ownership filings are accurate and current under the new FinCEN requirements. Getting those filings wrong or failing to update them as your ownership structure changes creates compliance exposure that can be both costly and time-consuming to resolve. Fifth, turn on real-time transaction alerts on your bank accounts if you have not already done that. This lets you see immediately if something is being flagged or held and allows you to respond quickly rather than finding out about a problem when a payment fails at the worst possible moment. Sixth, if you are borrowing from a credit union, take time to understand exactly what interest rate cap applies to your specific loan product given the extension of the 18% general cap and the 28% payday alternative cap. The difference in total cost between those rate environments is significant and worth understanding clearly before you sign anything. Seventh, and this is the underlying principle that ties everything else together, operate clean. Keep your financial behavior organized, documented, transparent, and as predictable as possible. Not because you have anything to hide, but because predictability is genuinely rewarded in a tighter monitoring environment. Automation does not evaluate your intentions. It evaluates your patterns. Giving the automated systems clean, consistent patterns to work with is the single most effective thing you can do to move through this new environment with minimal friction. This is not about fear. I want to be direct about that. The financial system did not collapse on March 1st. Your money is not in danger because of these regulatory changes. What happened is that the system recalibrated, and when recalibration happens, the people who understand the direction the system moved are in a much better position than those who do not. March 2026 tightened things slightly, strategically, and systematically across multiple points in the financial infrastructure. If you stay organized, stay proactive, and stay intentional about how you manage your money, you are going to be fine. What gets people into trouble is not doing anything wrong. What gets people into trouble is assuming that because they are not doing anything wrong, the automated systems will somehow know that without any help from them. That assumption is no longer safe in the environment that took effect this month. Stay aware, move smart, and drop your thoughts in the comments below because I want to know how you are feeling about all of this and what questions you still have